Hey, it's Brad Barrett here from the Make Your Money Matter show. And on today's hot take, look, we have a lot to talk about. Specifically, Silicon Valley Bank. As you may have heard, many of you read and probably, again, heard this, that it collapsed on Friday, March 10th, and the media has been in a frenzy. But I want to break it all down for you today and explain what it means for investors and your money. But before I do that, make sure to smash that subscribe button, hit the notification bell so you don't miss a single episode. All right, let's get into it here. Let's start here. When you have something like Silicon Valley Bank, this situation, when you have that happen, you'll notice there's a lot of fear selling that follows. There's a lot of remembrance, and I'll call it a hangover effect from things that we can all glean from that are similar but not the same. And that's important. Similar but not the same. And you probably know what I'm talking about. There's a lot of rhetoric and narrative over the past week that a bank is failing, eerily similar, but again, not the same to what we saw in basically 07, 08, and then really coming into 09 through the financial crisis. And I'm going to address that. And I think it's important to understand what happened with SVB. And we have to understand exactly how banks use the money we deposit first. Now, normally, banks will take your deposits and lend it out so that they can make money from your money, right? Makes sense. That's the game. That's been completely normal for many, many years. And it's been happening this way for a long time. That's how we have arbitrage in this market. So as rates were low, which we saw for the past 15 years, but really low during the pandemic, Silicon Valley bought long-term treasury bonds and government-backed securities, which again are deemed quote unquote to be safe investments. That I can understand. But let me go into detail on this. The challenge is, as we all can see, is when interest rates rise, because fixed rate bond values typically decrease when interest rates are rising, which led to significant losses for SVB. Now, real quickly, as a quick aside, the reason why bond prices go down when interest rates go up is because when interest rates go up, new bond issues become more attractive and your old one doesn't, because you're at a previous or yesterday's rate. So it's lower. So you have to devalue, or what we call sell at a discount. Now, to complicate the issue here, with interest rates rising, it's now more expensive for startups to fundraise. You want to think of like Shark Tank as an example. It's harder, more expensive to fundraise in a higher interest rate environment, okay? Which means, and for those of you who realize that Silicon Valley Bank's main focus was venture capitalism and basically alternative investments and startup companies, essentially. This means less deposits for this specific bank. So with less fundraising, many unprofitable startups had to dip into their deposits to pay for regular expenses. You can see how this is kind of going in categorical and in a timeline here. No different, by the way, than things like daily payroll as an example, which became harder for these firms to pay. Now, as such, you can see very clearly through this, I wanted to share at the beginning here that SVB not being able to meet the deposit redemptions eventually signaled a cash liquidity crunch. This is where you heard the term a run on banks. Now, what I've seen with the news lately, and why I want to address it this week on the hot take here on Make Your Money Matter, these huge lines, and I'm not saying that's wrong, but it was from a fundamental reason, I think. It wasn't just like total emotional, erratic fear. Now with it, it signaled a cash liquidity crunch, and really they tried to sell their investments, which we saw earlier last week. So SVB tried to sell their investments to meet demand, then tried to actually sell themselves, as we saw middle of last week, in an effort to raise what they deemed about $2.25 billion essentially to stay afloat. So obviously, this spooked some investors, and likely many of you who are watching and listening to the Make Your Money Matter show, and they're kind of like, spooked investors. If you're at this bank, you're like, give me my money, right? Which is fine, only if a few companies did that. The challenge is everyone said that simultaneously. So in the finance world, they call this, as we saw in the news, a bank run, a run on the bank. So customers tried to pull out basically, and here's the numbers, nearly $42 billion within a matter of a day. And eventually SVB ran out of money. They couldn't provide it. So the stock started to fall, as we saw on Thursday, and then eventually collapsed last Friday. So this bank failure, as I'm bringing it up, and I know it's topical for everyone, which is why I wanted to address it. It sent shockwaves through the entire, really the tech industry, both domestically internationally, largely because SVB was tech focused on startups. And by the way, it's estimated that close to 65,000 startups could essentially miss payroll if regulators did not step in, which we now saw that they did. So quick aside on that, FDIC, which is the Federal Deposit Insurance Corporation, took over SVB on Friday. And essentially, they said they will back all of the depositors' money, which again is a good thing. So that's the setup of the background. Now, many of you probably read this, and hopefully many of you know that if you didn't, hopefully they give you some background on really how banks work and some background as what happened last week and how quickly it happened as this all came to light. One thing I want to share, and I actually just had a conversation with our Chief Investment Officer, Steve Calley, my partner here at One Capital, and we're talking through this with our clients on our radio programs and obviously here on the show. My first question to him was this: is this going to be a singular event? Now, obviously there's going to be some spillover with how this is going to roll out, but you got to think with deposits running their money, they have to put the cash somewhere. So those that are getting their cash from SVB, they has to go somewhere. Maybe the big banks, maybe other regionals. So especially SVB guys are going to necessarily go and put it in, they're not going to go put it in a hole in their backyard. These are sophisticated, people, right? So you can see over time, this is an opinion at this point, that we're going to see potentially an increase in larger banks and maybe shore up of some of the things in regional or smaller banks. Because again, these money just doesn't dissipate. And it's an interesting market right now. Now, of that $42 billion, here's some specific math that I wanted to share. There was only $26 billion that was available to fund for withdrawals at the time when this bank run happened. This was as of Friday. So that's how you can see pretty easily that people want $42 billion and they only have 26. That's how they fail. Now, this is to me a problem of management just the same, all right? Now get this. This is what's crazy to me, and I want to share this. This is a little bit of Brad's opinion here on this whole thing as it was unfolding over the weekend. I'll give them a pass on putting billions of dollars in 10-year treasury notes earning 1.5%, because basically when you put it in that way and you lock it up with 1.5% and you have a general rise like we saw over this past year in interest rates, they got creamed, okay? I'll give them a pass even though I still think that might have been bad cash management. What I'm not going to give them a pass on necessarily is the fact that venture capital firms at this bank in particular and startups put nearly $200 billion with them and they left it at the bank. There was no money management or cash management with it. As you hear me say on this show, a large part of cash management and portfolio management, they need to go together. You have to make sure that if you're sitting on cash, it's not just sitting there in a bank, not insured. So part of this, I should say this is mismanagement and maybe poor management at the bank. This isn't necessarily a systemic thing that's going to feel through all of the banks. Now, obviously, we have yet to see this fully come to life. Obviously, we're seeing this week with Credit Suisse and other things going on. I hate to say it this way, but it almost like you can't fix stupid. And I know that might sound crass, but I give them a pass because they did put a large amount, at least in something that was earning, less than, at least 1.5% in treasury notes. But then they went over and then they just left all the other deposits in cash at the bank side, not even in the wealth management division, so to speak. So I just think that's crazy when you think about it. So sometimes I wanted to share here today on this whole thing that's going on is you got to look under the hood and look at how we would look at things when it comes to cash management and just really what this particular bank did wrong. And then ultimately your question would be, okay, is this a sign of other things to come? In our opinion right now, as you look at things, this might be more singular than widespread. We're going to see some spillover. We are seeing it this week, obviously, with things like Credit Suisse and other items. But it's really one of those things where you start looking at it, the solvency of bigger banks, as an example, and all the reform that happened after the great financial crisis in 2008, 2009. Banks, right now, if you look at it across the board, they are very stable. Now, again, that's not necessarily a blanket statement just to go out and invest in any bank. Do your research. Make sure you sit with your advisor. But it's interesting to note as you look at the broader market. Hey, I hope you enjoyed that today. And I hope that gives you some background as to what was going on last week. And if you liked what you saw, please make sure to subscribe to our show. And always remember to make your money matter.